This is an uncovered Japan company research report on Tsugami Corporation, ticker 6101. Tsugami makes the machines that make small metal parts, precision CNC automatic lathes that turn bar stock into components for electronics, vehicles, and medical devices. Its 28% operating margin leads the machine tool industry. The tension is that roughly 80% of sales, and an even larger share of profit, comes from China. The report is dated July 6, 2026, using a 6,710 yen reference price from June 11th. Forward earnings are valued at 18.4 times and price to book at 3.9 times. Those are premium figures for machinery. But Tsugami earns a 23.4% return on equity and carries about 33 billion yen of net cash. The valuation debate is whether those returns are durable or near a cyclical high. A Tsugami machine feeds a coil or bar of metal through a computer-controlled lathe and cuts thousands of tiny, repeatable parts at micron tolerances. Those parts include smartphone connectors, fuel injection nozzles, surgical screws, and electric vehicle sensor housings. Automatic lathes supplied 84.1% of fiscal 2026 sales. This is not a broad industrial conglomerate. It is a century-old specialist in one narrow, high-value production task. Tsugami does not merely export machines to China. It casts, builds, sells, and services them locally, close to customers, and largely in renminbi. That removes freight and import friction, while shortening lead times. The result is a China segment with roughly 30% margin and about 80% of group sales. It is the clearest explanation for Tsugami's superior economics, and the largest source of earnings risk when China's capital spending cycle turns. From fiscal 2021 through fiscal 2026, revenue rose from 61.6 billion yen to 129.1 billion, a 15.9% compound rate. Operating profit increased from 9.5 billion to 36.1 billion, or 3.8 times. This is genuine structural growth, supported by automation, electronics, and electric vehicles. But the path was not smooth. Both revenue and profit fell in fiscal 2024 when China softened. The moat has three connected layers. First, Tsugami's fully local China model is difficult for export-oriented competitors to copy. Second, it controls the value chain from iron castings through design, manufacturing, sales, and after-sales. Making the heavy cast bases in-house supports the rigidity needed for micron precision. Third, the Nagaoka mother plant retains the accumulated design knowledge, while service and parts keep customers tied to the platform over a machine's 5 to 10-year life. Fiscal 2026 operating cash flow reached a record 28.6 billion yen, with free cash flow of 26.5 billion. That comfortably covers the roughly 12.9 billion yen investment program across China, India, Japan, and Western sales bases. China gets added capacity, while India receives a foundry and assembly operation. Growth is being funded internally, without stretching a balance sheet that already holds substantial net cash. Management's operating strategy has two axes: deepen the profitable China franchise, and scale a locally built Indian business. India opened a foundry in 2024, an assembly plant in 2025, and recorded its first segment profit in fiscal 2026. The chart's 200 billion yen marker is explicitly the report author's illustration, not a company target. Tsugami discloses no numeric long-term goal, which itself limits market confidence. The thesis can be monitored rather than guessed. China's purchasing manager data and electronics investment remain the immediate earnings tells. India's profit progression in fiscal 2028 and 29 will show whether the group can reduce its concentration. Investors can also watch for numeric, medium-term targets, an end to recent chief executive turnover, and stronger capital returns. The report notes 4 consecutive dividend increases, but a payout ratio of only about 23.5%. Valuation is no longer obviously cheap. The stock ended fiscal 2026 on 8.85 times trailing earnings, while the report's current forward multiple is 18.4 times, almost twice the 5-year historical average. The chart mixes fiscal year-end trailing figures with today's forward measure, so it is not perfectly like for like. Even allowing for that caveat, the re-rating is real. The market is starting to price persistent quality rather than an ordinary cyclical peak. These are the report author's scenarios, not recommendations or price targets. For fiscal 2029, the bear case is 1,980 yen, the base case 7,210, and the bull case 12,860. The current reference price sits close to the base case, with a severe downside tail if China earnings and the multiple fall together. The upside requires durable margins, continued growth, and a market willing to preserve a growth-style valuation. To conclude, Tsugami is a genuinely exceptional niche operator. Local China production, in-house castings, precision know-how and service lock-in support industry-leading margins, while net cash and record free cash flow fund expansion. The trade-off is equally clear. One country supplies most sales and profit, just as the valuation has re-rated. The key question is whether India and stronger governance can diversify that dependence before China's cycle turns. For the full evidence, assumptions and sources, continue with Uncover Japan's free deep dives. For a much deeper look, visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.